All right, it's showtime. Hi, folks. So what is protected investing and how does it work? Well, they are exactly the questions that we intend to answer today on this webinar. We're so extremely excited to be discussing this topic today, because we believe in it so much, but also because it's great timing too. Since both the stock and bond markets are in such major corrections at the moment. And as a result of that, so many people are wondering if there's another way to go about investing that isn't as risky, but can still provide respectable returns without locking in their money for long periods of time. Well, I have to tell you, if that is you, then you're really going to enjoy this webinar today. Not only are we going to take a reasonable dive into this important topic, but we're also using this opportunity to introduce a third-party money manager named ZEGA Financial, who we feel are the quintessential experts on protected/hedged investing today, and with whom we have been working with to allocate portions of several of our clients' portfolios in order to further secure and diversify them with this type of investment strategy. On top of that, we're super jacked to be hosting this webinar with ZEGA Financial's Director of Business Development, Michael Puck. Mike is a chartered retirement planning counselor who formerly worked as a trader in New York on the New York Mercantile Exchange, where he traded commodities, and as a vice president with JP Morgan Chase and senior financial consultant with TD Ameritrade. Thanks for doing this with us, Mike. It's great having you here.
Thanks for having me, Brian. I'm looking forward to speaking tonight.
I tell you, when you agreed to do this, I was like, man, this is going to be a good one. That's for sure. I just knew in my bones, if I could get you to do this with us, everybody was going to really enjoy the ride we're going to take them on. Don't you think?
Yeah, absolutely. I think it's a tough market, like you said. The stock market's down, the bond market's down, the tech market's down. What do we do? How do we invest? So we got a couple really good ideas that we're going to share tonight.
Awesome. Well, all right, folks. So I hope I can tell you, you can tell that we have a really special workshop planned for you today. One that I think that it's not just going to be educational, but I think Mike was just alluding to it. I think it's going to be kind of enlightening a little bit, don't you, Mike?
Absolutely. Yep.
Usually this topic of this type of investment strategy usually is, I find. Okay. With that said, I want to thank each of you for attending today. Our topic, as you know, is what is protected investing. My name is Brian Dougherty of PLC Financial Solutions. I'm your regular host for tonight, but unfortunately, my beautiful, wonderful partner in business and life, Rachel Dougherty, who is usually our moderator for all of our webinars, will not be with us tonight because of previous business obligations. She usually handles all the comments and questions as we go along. But for tonight, you're stuck with me, unfortunately. And I know I don't look as good as her, I'll tell you that. I will do my best to get it done. And also, as we go along on that, I'm going to be dealing with the Q&A and the comment boxes because of her absence on tonight. I'm dropping my notes here, Mike. That's not good. I need these things.
You're already a mess without her, right?
Right, exactly. All right, so before we get started, let's take care of some general housekeeping now. If the screen is not big enough for you to see, you can click on the view options drop down at the top right of the screen to make it larger. I know sometimes the text in these are not big enough for some people to read. Also, you'll see that there are two boxes at the bottom of the screen, one called chat, and it's for your comments, and the other is called Q&A, and that's for your questions. And of course, normally Rachel would respond to them in kind, but tonight it will be me. So I'm sure that many of you also are going to have questions about the material that we're covering today. But since we have a good bit of material to cover and only an hour to cover it, I'm going to ask you to put your comments and your questions in those boxes below. And at the end, we'll be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call. I'm going to be posting a link where you could book one with me right on my calendar. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You're going to have plenty of time to check it all out again at your convenience. Also, because we want to make sure that you're all paying attention and because we want you to have some fun as well, before we answer any questions, we have a 6-question quiz, as always, for you at the end. And the first person to answer each question correctly inside the comment box will win a $10 gift card to a store of your choice. So make sure you have a notebook handy to jot down some brief notes related to some special bullet points that I'll be pointing out. When I go bullet point, you're going to know, get that notebook out. So finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor, and we only transact business in states where we are properly registered or excluded or exempted from registration requirements. Now, SEC registration is not an endorsement of the firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have a potential for profit or loss. So now that we got that one out of the way, I have one for you guys as always. Why doesn't the son go to college? Because he already has 1 million degrees. I thought that was good, right? For the, not that it's a good joke, but it's appropriate for the weather that we're having, right? That's a good one. And I found that one myself on the internet, Mike. So, you know, I usually steal these jokes from my kids, right?
Ah, okay.
They ran out, so I ran out. I had to go to the internet this time.
All right.
But I'll keep a day job because I know, everybody's thinking that. Okay, so now let's get started. Let's see. So, folks, who is ZEGA Financial and what are they all about? Well, to start, jumping ahead of me here, Mike. They're a registered investment advisory firm with over $640 million under management that was founded in 2011 with the philosophy and purpose of utilizing options investing offered to the general public as a different way to invest where risk can be mitigated and returns still exceptional. Okay, they've been recognized as expert investors by both Fox Business News and the Wall Street Journal. Also, several of their portfolios, okay, let's jump down, have been awarded 4- and 5-star ratings by Morningstar. And they are and we're going to go through these later, but they are the Buy and Hedge Retirement, the High Post Conservative, the ZBIG IRA, and the ZBIG Leveraged portfolios. And we'll talk all about most of them coming up. We're going to mention them all, but we're going to get a little deeper into some rather than others. That's what's jumping on me. So, okay. They're claims compliant by global investment performance standards, which are a set of voluntary standards used by investment managers throughout the world to ensure the full disclosure and fair representation of their investment performances. The main principal and CEO is Jay Pestrichelli. Is that right? Did I say that right? Jay
You
Pesca.
said, yep, Jay Pescarcelli. He did a great job.
All
Yeah.
right. I was worried about
The
that
Italian guy.
last time. He's a financial advisor and former online product developer at TD Ameritrade. He's also the author of the book, which I read, called Buy and Hedge, the 5 Iron Rules for Investing Over the Long Term, which is available on Amazon, which is where I bought it. I'm trying to get these to coordinate here. You guys gave me one of these tricky slides here where you got to do one at a time.
Yeah, this one is a tricky one. Yeah.
Okay. I usually do the static ones, but I'm working on it. Okay, couple quicker excerpts from the first couple of pages of the book that I think really stood out to me right away is one, understanding risk and reward is their passion. Man, when I read that, Mike, I almost jumped through the page. You know, I really did, because one of the number one things I'm always going through with my clients is to understand the risk return or risk reward profile of their portfolios and how big a difference that is. Seeing ZEGA, that's their passion. I'm like, that's my passion. We are aligned. And second, that risk is what you take on. Return is what you plan for. And that's why they use advanced option strategies to take profit while protecting from volatility in the marketplace. I was like, protecting from volatility, you know, oh my goodness. That is the second thing, my motto. You really need to protect for volatility in the market. I think everybody's seeing that today, right?
Absolutely. Lots of volatility in the market today.
We're going to get into that in a little bit. Mike's going to break that down as well. So finally, ZEGA is one of the few options-based money managers that offer their services to the general public directly through other RIAs and IRAs like myself, who have a proven track record of success in providing these type of portfolios. Mike, on all that, is there anything you'd like to expand out on these things?
Yeah, so a couple of things. You know, you mentioned the book. So Jay Pescarcelli founded the company 11 years ago. He ran the trading desk at TD Ameritrade for over a decade. Like Brian mentioned, I started off on a trader on the NYMEX in New York. So our team has over 140 years of trading experience between us, our investment committee. We have depth at all different angles when it comes to trading and understanding the markets. You know, you mentioned a couple other things here, the GIPS compliance, right? So we claim GIPS compliance. So that means numbers that we're going to point out later today. Those are all audited by a third party, right? So we're not just showing you numbers, we're showing you audited numbers, right? Official numbers. And then Brian also mentioned Morningstar, right? So we have currently 12 of our strategies are ranked by Morningstar. That's something we're very proud of. If you haven't heard of Morningstar, they're one of the companies that ranks the individual strategies out there. 4- and 5-star strategies are usually at the top, and that's what our 12 strategies are ranked today. So other than that, you know, I think if you're interested in learning more about options, Buy and Hedge is a great book. There's a lot of good pieces in there around protecting portfolios. You know, Brian mentioned risk, right? We talk about this in the book. We want to smooth out the ride for our clients and our investors, right? So, you know, there's ups and downs, and this is a great example of it. You know, the S&P 500 year to date is I'm looking at it now, is down 18%. The NASDAQ, the tech market, is down 26%. And the bond market's even down 9% year to date. So, right, that's a real volatile market. So how do you smooth out those returns? That's something that we really specialize in. We talk about that a lot in the book. Brian's going to point out some really neat stuff around why controlling volatility gives you better performance long term. So we're going to hit a lot of really great points tonight. Thanks for a great introduction on this, Brian. We're really proud to work with Brian and advisors like Brian. And Fusion Capital Management. And we mentioned one other thing is these are institutional strategies, right? So this is institutional stuff that's usually offered at the pension funds and huge endowment funds, right? But we felt that this is necessary to bring to individual investors. So we offer it. We don't work with individual investors directly, but we work through Brian as a strategy that's available to him and his team. So we're excited to talk about some of the things tonight that make us different and we think can help improve your portfolio and its performance over the long term.
Well, I'll tell you, Mike, it was perfect alignment. Between, our philosophy here at our firm, our little niche, and what you guys do, it resonated, with me, and I'm certain several of my clients that are on the phone already are on the webinar with us already. That's why it just, really pumps me up to be able to, first of all, find anybody that's got that same mindset. But also too, with this type of investing being, one of the more complicated types of investing, you don't see a lot of individuals really getting too in depth with it. I'm going to give some examples, but I get real basic about the examples just to give people concepts. And, we went over that before. You'll see, we'll share that with folks. But, for us both to be beating on that same drum and you guys to be like this, super high powered, firm who's been rocking it for quite a while like this, really makes me feel like, kind of good. You know what I mean?
Well, that's great. Yeah. I mean, and we're excited. We've been working together for a while. We've been working with Fusion now for 9 years, right? So we have a long relationship with your company, and a term that you'll probably hear us tonight, right? Anybody on the call is protected growth. And I think Brian and I will probably say that 100 times. And I think that's one of the staples of what we do here at the company is we believe portfolios need to grow, and they do, right? We all need to grow our portfolios over time, but we don't think that they should just, you should just bet, like you're going to Vegas. We think you should have protected growth. So you're going to get some level of growth, but you'll have protection there. So you'll hear that term a lot, whether it's from Brian or myself this evening.
Absolutely. So let's jump in a little more. Okay, so let's talk about protected or hedged investing and how it works a little bit. So first, it utilizes one of the least understood techniques in investing. And I'm going to do it again. You're going to see me do this. Bullet point for the notes. Remember, for the quiz, the use of stock options, which is definitely a little bit complicated. But I want to emphasize that doesn't mean that it is riskier or more speculative because it's complicated. For some reason, people have somehow equated the two. And the truth is that it is exactly the opposite of that, because stock options were created in order to reduce the risk of investing, not increase it. So let me give you a basic example of that. Many times, we hear about employees receiving stock options instead of the actual stock in a company from their employers for various different reasons. Could be a bonus, could be a part of a retirement package. The basic idea is that employee, through the ownership of that stock option, now has the right to purchase their company's stock at a certain reduced price in the future. It'll happen something like this. If the designated price of that stock that they're guaranteed to buy, also known as the strike price, is say $20 a share. And in the future, that stock is worth, say, $100 per share. Then that employee, when they exercise that option, will then buy $100 stock for $20 a share. If they buy the stock, then immediately sell it, they'll make $80 on each share. If they were given, say, 100 shares at that $20 strike price, they end up paying $2,000 for $10,000 worth of stock. Does that sound like it's a riskier stock purchase or a risky stock purchase? Of course not. So, and the truth is that you don't really even need a company to give you these stock options. Anyone can buy them and do the same thing themselves. Of course, the stock value could go down too instead of up, which would render the stock option worthless after a certain amount of time, because the type of stock options that you buy yourself have time limits on them. So you still need to know what you're doing, but these days You don't have to buy them just for individual stocks or companies. They can be purchased for shares of an exchange traded fund, ETF, that mirrors, say, the S&P 500 index or any of the major exchanges or indices like the NASDAQ or the Dow Jones Industrial Average, any plethora of them, which makes it a little easier to get a feel for the direction of how things are going, since every major news outlet in the country reports on them multiple times a day. The bottom line is that stock options are used by investors to hedge against potential losses of the value of the stock or bond-based investment, which is done, which, if done correctly, will reduce the risk of the portfolio. Also, it's worth noting that they do have a cost related to them, so that they will, and they will actually cause your return to be reduced based on that cost. But since they sell the option for a fraction of what the stocks actually cost, the reduction in the return is well worth it to protect against the market losses that they help avoid. Plus, of course, when someone knows what they're doing with these types of strategies, like ZEGA, for example, and they can use more sophisticated and advanced type strategies. Mike's going to discuss ZEGA's portfolio strategies in a few minutes. At the end of the day, these protected or hedged investments end up reducing the volatility of the investments so much that the compounded returns usually end up being superior to unprotected or unhedged investments. And when this happens, the risk-return profile improves dramatically, thus not only causing the risk to reduce, but also causing the return to be better than average over the long run. So, Mike, can you explain a little bit how you explain the basics of this to people?
Yeah, well, I think when it comes to options in general, they're used in portfolios every day. And institutional clients use them all the time. And funny enough is even being a retail investor is most likely there's some product or strategy that you may own that actually owns options in it. So funny enough is if you own, anyone on this call who owns an annuity, most likely inside that annuity has option structures. But when you purchase that annuity, it just wasn't really talked about, right? It's just said, hey, this is an annuity and this is how it works. Well, the inner workings of that annuity may be made up of options. There's a pretty high chance that probably is. So options are a great way in Brian's example, right, where we can get exposure to certain areas of the market, but we can take much less risk when we do it, right? And instead of risking 20,000, we risk 2,000. Instead of risking 100,000, we risk 10,000, right? And we can actually get the same level of exposure with a lot less money, right? So if you invest $100,000 and the market moves up 10%, well, you made $10,000. But in options, you might only have to invest $10,000 and you still make the same $10,000 as the market goes up in value. So there's a lot of different things and uses for options. And some people think of them as very speculative, right? They're very aggressive. Well, in our case, we actually use options to be very protective. So yes, there's absolutely speculative investment strategies out there, and we're going to actually talk about one tonight. It's really aggressive. But the majority of our strategies, and here's that term I mentioned, the majority of our strategies are protected growth, right? We use options to provide growth for our investors, but protect them if the market is downtrending or a down market. So they don't have to be speculative. They can certainly be protective, and there's lots of uses. And I promise you, if I look through your portfolio today, you probably own some options somewhere. You might not just know.
Yeah, I every year with my clients, and several of them on here, with the ones that have annuities, they have indexing strategies that are all linked. They call them linked, right? They're linked to their the amount they invested in that annuity. Every one of them is based on option strategies, right?
Yeah, absolutely. Yeah. So any index linked annuity, you don't know this, but they build those, and those contracts that you purchase, they're actually built with options contracts. So if you own an index linked annuity to the S&P 500, well, there's S&P 500 options inside of that annuity. If you own an index linked annuity to the NASDAQ or to the Russell or to the bond market, well, there's options contracts on all of those. So there's contracts on individual stocks, on individual indexes, on really just about anything. There's options contracts. So you probably own them, you just don't see them every day.
And what a lot of people don't realize is, although annuities have that guaranteed, principal element to them, but they have the restrictions with the surrender charges and all that, that many of these things that you're doing are identical to those, in terms of from an investment point of view and growth point of view and protection point of view as they're doing inside these annuities, but you wouldn't have any of the restrictions.
Yeah, that's correct. So, one of the strategies we're going to discuss shortly, we like to call it a deconstructed annuity, right? Because what we've done is we've gone in and we've done a very similar structure to an indexed annuity, but we've deconstructed it. And so what we do is we made it liquid. So you get the same type of feel and exposure that you might get with an annuity, but we have daily liquidity. Why is that important, right? As well, if you had an emergency or you needed to take money out or you were unhappy or whatever, for whatever reason, you could always pull the money out. There's no surrender charges and there's no entrance fees, no exit fees, right? We've basically, with some of these strategies, we've turned these into deconstructed, highly liquid indexed annuities with really juiced up growth rates. I mean, that's one of the things too, is a lot of times and annuities have a place for everybody, but it can maybe be a little less growth oriented. So some of the stuff that we work on is we focus on daily liquidity and that same feel of annuity, but we try to accomplish more growth, so more upside potential if the market really does well.
Absolutely, because most of the annuities have caps of some sort, and over recently they've gone up somewhat, but
sure.
If you compare them to how like some of these are designed with yourself, similar kind of concept as far as the downside, but not the same on the upside. You're really, we were talking about this being enlightening. Well, that's, I think, going to be the enlightening part.
Yeah, yeah, absolutely. And so this works a lot. A lot of times our strategies will work really nicely with an annuity, right? Is you can kind of pair them together and you can get a real protected portfolio where you kind of have a bottom across the board. We can give you a little bit more growth. They might give you a little more protection in the annuity, right? So they work very nicely together as well.
Yeah, because they do guarantee the principal, where you guys can't do that. But correct. You are putting strategies together that are secure in a tremendous amount. So it's yeah. You could have that, kind of complement each other. All right, so let's look at this. So you wanted to talk a little more about this. Hold on. So we went through that. Okay, yeah. So let's talk about this.
Yeah, let's
when it comes
elaborate on downside protection
and options, and because I know you wanted to use this as an example to drive again the point home of the use of options.
Yeah. So what we're looking at here is hedging, and I think Brian's we're going to talk about this, right? Is hedging and protected. Those are interchangeable words for us in the investment world. Is hedging or protecting your portfolio. That's what's important to us, right? Protected growth is really our goal here. And so why is it important to protect on the downside? So I mentioned earlier, and I'll get these numbers up again, right? The market's down 18%, the S&P on the year. The NASDAQ's down 26, and the bond market's down 9, right? I mean, down across the board. Well, what's important about that? Well, what happens if you protected your portfolio? And let's start over on this circle here on the left-hand side of your screen. And the red bar there is how much the market goes down. And what the green bar shows is how much you would need to make after the red bar happens. So for example, on our far left here, if the market dropped 10%, what you would need to make to get back to even would be 11%, right? And you may scratch your head. It may not make sense to you, but if you do the math on it, think about a $100 bill. If you invested $100 and you lost 10%, well, you got $90, right? Well, now if we make 10% back, well, because we're now starting with $90, we're starting at a lower level. Well, we only make $9, right? Because 10% of $90 is $9. So we don't get all the way back to $100. So if we lose 10%, we actually need to make 11 to get back to even. So there's a little bit more of a downside there. Now, as you start to work your way across the screen here, is look what happens when you start to lose more, right? So that second example is if you lose 20%, well, now you need to make 25. And then the third example is you lose 25%, you need to make 33. And you can see as we lose more, we need to make more. If we lose 30, we need to make 43. If you lose 40, you need to make 67. And lastly, that last one here is interesting. And I really like this example is if you lose 50%, think about that. Let's use our $100 example again. If you lose 50%, you're down to $50. Well, to get back to even, you need to make 100% of your $50 to get back to $100. So you lose 50%, you need to make 100% to get back to even.
Right.
So this is a great way to think about downside protecting and what's important, right? So right now, like I mentioned, the market's down 18%. What if you were only down 10%, right? Or 8%, right? Well, while the rest of the market's catching back up, when we start to head back up, you're already going up, right? You've already made your money back and you're off to the races. You're positive performance-wise. You're starting to make money while everyone's just trying to get back to even. So this is a great example of showing why it's important to protect more. So what kind of ride do you want when you think about your investments, right? Are you okay with down 25 and up 33? Or do you want to have a smoother ride that might only be down 10 and then you only need 11 to get back to even? So Brian's going to discuss this in the next few slides, but this is really important when you're thinking about your portfolio. And this is where we use that term again, is we want to have protected growth. So if the market drops, we have a protected level in or a floor in. And if the market goes up, we get some part of that and we get some appreciation.
And I think this is a good, because I talked to some clients sometime and recently, and they're like, they call, and one of the things, like I may have come over from another firm, and one of the first things I do, because they're upset, they're down, is I go back to their portfolio they were in, and I see, and I do a test against that to see where that would be, right?
Sure.
Recently it happened with me, and clients down, I think like 14%, that the other policy, the other plan would have been down about 21 or 22. It was an extra $10,000 or so dollars that person's would have been down. And they think it actually, and the point I make is sometimes you are paying to lose less than you would have.
Sure.
Right?
Yeah.
And it takes massive skill to be able to get that person to lose less than they would have, so that then this type of concept works more in their favor moving forward. Does that make sense?
Yeah, absolutely. Yeah, it makes a big difference, right? And we can see that right here. It's, if your portfolio is down 25% this year, you got a lot of ground to make up versus the investor that's only down 10, right? If they had a more protective portfolio, that protective growth portfolio, they only need to make up 11% to get back to positive. Why that 25% down investor needs to make 30+% to get back to even, right? So they got a longer road ahead of them.
Absolutely. All right, so let's okay, so that being said, the major reasons why to utilize protecting investing today are: one, volatility is back in the market, both stock and bond markets, like we mentioned, in a big way. We've seen 4 corrections of 10% or more this year alone. Okay. And the last one was the 20%. Now we've made up a little bit, right? On the 18, right?
Yeah, a little bit.
Absolutely. The truth is that volatility in the market is always there, though, and it will always cause compounded returns to be less than investments that incur less volatility. We'll show you some examples of that soon. Now, bullet point now, get the notepads out. Okay, the bottom line is that investments that experience less volatility will always do better than their higher volatile counterparts, even when their average annual returns are similar. And we're gonna talk about that, right? So that bullet point is, what's one of the most important things about controlling your portfolio? Volatility. Volatility, remember that word. Okay, so let's jump on and talk about volatility a little here, Mike. So here's a chart of the Chicago Board of Exchange Volatility Index, also known as the SIBO, and it's also known as the VIX, which is a real-time market index representing the market's expectations for volatility. Now, another bullet point here. You can see that from 1991 to 2021, there's been over 20, let me say that again, 20 major corrections that have occurred. And that doesn't even include the 3, 10, and 120% correction this year, which has been more than average, and certainly not the worst that we've ever seen. So, Mike, can you tell us about this and how it applies to what people are experiencing today?
Sure, yeah. So I know this chart may look a little intimidating when you first look at it, right? There's a lot going on here. But what's important to focus on, and Brian, if you hit forward one on there, so those come back, perfect. Yeah, perfect timing. So what's important is to look at is these little parentheses, these cones here, right? And what this shows us, and what's important here is that just like anything in life, really, is things go through cycles. And so what you start off with here on to 1991 through 1998 is a period of low volatility, right? You didn't have a lot of market moves, just kind of steady Eddie, very, very calm market, a couple spikes, but pretty low volatility overall. And then you can see we go into a period of high volatility, right? So from 1999, 98, 99, up into 2003, you had a very high volatility time. If you think back, what was that? Well, that was the dot-com bubble, right? We experienced the dot-com bubble during that time. So same thing, then we had a low period of volatility from 2003 over to 2007 and 8, and then followed by a high period of volatility, and then low period and high period. So what this shows us, and what's important to know here, is that nothing bad happens here, but it just shows that volatility happens in the market. There's periods of low volatility and periods of high volatility. Like Brian said, you got 20 major pullbacks over this time frame. Well, most of those happen during periods of high volatility. So that's something to think about. Now, what I'll leave you with here is, if we go all the way to the right, we look at 2013 and we go over to 2020, kind of a low period of volatility. And now we got our blue cone on top here, a high period of volatility. The question is, how long does this last, right? Does this last 3 years, 4 years, 5 years? Is it a 10-year period of high volatility? But right now, we're certainly experiencing high volatility. We have a negative 20% market this year, and volatility is here to stay. So I think we see this for a couple more years. We don't see that smooth ride that we've had over the past 8 or 9 years. So all this tells us is there's lots of volatility in the market. Sometimes there's more than others.
Yeah, I mean, you can see this one over here lasted from 97 to 2003. You're talking 6 years.
Absolutely. Yeah, that was a big one. It lasted 6 years. And these are big periods of volatility too, are big volatility spikes. I mean, look at 2008, right? We all remember that the housing crisis. But I mean, these are major volatility spikes here. So we experienced that. If you look at the furthest to the right here, that's COVID, right? You had this big spike in COVID, and now we're back up with inflation and all these different things happening. So it's a period of high volatility. And what we're going to talk about when we get to strategies is there's ways to take advantage of that volatility. So there's opportunities here for investors.
Absolutely. And obviously that one on the right would be a little wider if it included this year. And we don't know how wide it's going to get, right?
We don't, yeah, that's the big thing. We don't know. I mean, is it 2023? Is it 2025? Is it 2027? We really don't know.
Absolutely. Okay, so when it comes to market volatility, it's affected investment, how it's historically affected investment portfolios. Well, let's take a look at a hypothetical comparison of two different portfolios. I've actually used this. I actually used this slide for a different purpose last month. In this slide, in the upper part of it, you can see this clearly when you compare the two wavy lines that are representing two different portfolios on the top graph view. So the orange wavy line, which represents the more volatile portfolio, has a range of plus 25% to negative 15% return in any given year. And the gray wavy line has a range of plus 15% to negative 5% return over that same year or any given year. And even though they both have an average simple return of 5% annually, the less volatile portfolio produces an actual return of 42.5%, which is 5.3% compounded annually over this 8-year period, versus the orange portfolio, or the more volatile one, being at 27.4% actual return, which comes to a 3.4% annual compounded return when you look at it in actual dollars. So folks, that is a difference of almost 2% annually. So this is a very big deal, how volatility is affecting a portfolio. Bullet point, another bullet point. I'm going to make this statement. It's a bullet point statement. Write it down. Compounded dollar returns are more important than average numeric returns. I'm going to say that again. Compounded dollar returns are more important than average numeric returns. Okay, also, the spreadsheet, you can see this, the spreadsheet, oh geez, jumped on me. The spreadsheet is this area on the bottom. Let me pull this down. I'm not seeing it here. What's going on? So I can't see all my numbers on here. I don't know what happened with that. So it's actually, what the spreadsheet is actually just taking these two wavy lines and comparing them in a spreadsheet, letting the spreadsheet run the formula. I actually did this several years ago just to make sure I could see that it actually worked the way this other slide was showing. And it actually figures out over an 8-year period that more volatile portfolio in dollars produces that much less, 1.9% less annually. So folks, the difference is almost 2% annually. So it's an unbelievably big deal. Also, at the end of the day, when you're reviewing your portfolio, making sure that it has a good risk return profile that minimizes your portfolio's volatility is of the utmost importance when it comes to maximizing your portfolio's potential long term. So now that you have a good idea of why it's so important for your portfolio to have a good risk reward profile that keeps its volatility under control, you now know one of the main reasons why our firm has preferred and gravitated toward both the tactical and protected approaches toward investing over traditional static asset allocation, the traditional static asset allocation approach that's dominated the investment world for so long. The bottom line is that the main priority when it comes to tactical and protected managed portfolios is the main priority is to minimize volatility, like we've been talking about, which in doing so also mitigates the risk of the portfolios drastically as well. So these types of investment strategies have been used and I know Mike was saying this earlier, at the institutional level for many years, but it's just been become accessible to the average investor through different third-party money managers like ZEGA Financial over, say, the last 10, 15 years. So you guys, ZEGA began in 2011, right?
Yeah, and people have been running these strategies individually. They just really haven't been offered at a firm level, through a company like Fusion Capital Management. But yeah, I mean, if you think about, you may have heard of the Harvard Endowment, right? I mean, I think a lot of people have heard of that. Harvard Endowment doesn't just go out and buy a bunch of stock and hope for the best, right? I mean, they use different strategies to protect their portfolio because they want that smoother ride. They want that calmer, smoother ride for their investors. And they use a lot of options in some of their portfolios. So there's really there's a lot of unique things that options are used for, and the institutions have been using them for a long time, a lot longer than retail investors.
Well, the people at Harvard are smart enough to use them, right?
Yeah, absolutely. They're harder. They're a little trickier to use, but they can provide a lot of good benefits.
Absolutely. Okay. So now let's talk about ZEGA. How ZEGA Financial does it. So what are their strategies for implementing stock options to create protected / hedge portfolios? Well, first, each model portfolio has a different approach and goal. Mike, can you explain how some of them correlate with the market and some don't, and how each suite of portfolios has a different risk level and kind of how that's going on with ZEGA?
Sure. So yeah, we have a couple different things that we do for strategies, and there's two real approaches that we like to talk about. And we're going to focus on two of those today. We have about four, but two of them we really focus on is one is protected growth, like I've mentioned in the past, and we have different levels of protected growth. So, if you were to say, hey, I really want to be conservative here, and I want to really limit losing money, I want to make it real conservative portfolio. Well, we have an option for that. If you said, hey, I like protected growth, but I want to be a little bit more aggressive, we're going to show you that as well. If you said, I like the idea of protection, but I really want to be aggressive, right? So we have different levels of protected growth depending on how much protection you want overall. So that's one. And the other thing that we'll talk about is an alternative income. So with this volatility that we just discussed a few slides ago, we have a strategy that takes advantage of that. We harvest the volatility, and what that does is that generates growth in portfolios regardless of what happens to the market. So we'll talk about that, but whether markets are up or down, we have an opportunity to make money. So those are the two we're going to focus on tonight: protected growth and alternative income.
Alternative, exactly. So, and I know we're going to get a little more into this, but just mentioning that some of them also may use SPY or the SPY ETF or whatever, the NASDAQ or what have you, as it associates, to how they utilize the market. Some might actually be more in fixed income type strategies and using more options for when they play into the market, right?
Correct. Yeah, that's right. So if you're in a more protected portfolio, you might have a lot of fixed income and a little bit of money in the S&P 500. If you're in a more aggressive portfolio, you might have more options in your portfolio, right? Or you're trying to take advantage of more of the growth of the market. So there's a number of different ways how your portfolio can be constructed with us.
All with options kind of built around them in a sense, right?
Correct. Yeah, all options based, right? We think we have a great understanding of utilizing and how to use options, and we think we can take advantage of the market through these different channels. And sometimes it's a little more fixed income, sometimes it's a little bit more options, but and ETFs, things like that. But overall, depending on your risk level, is where we're going to land on the strategy.
All right. So before we dig into the ZEGA model portfolio specifically, I want to let you know that we decided, and Mike alluded to this a little, for the purpose of this webinar, it'd probably be best for us to concentrate on only 2 of the 4 types, so that ZEGA, that they offer, so that we could take a deep enough, so we could go deep enough into each of them for everyone to get more, kind of a more complete idea of the full thought process that ZEGA puts into their portfolios. And believe me, in my opinion, they're impressive. So, and here's a bullet point. So today, we're going to be focusing on the ZBIG. Write that down. ZBIG and the HIPOS. That's HIPOS model portfolios. So write those 2 down. ZBIG and HIPOS. Okay. And that's really kind of what you were saying too, Mike, about one being more alternative with the HIPOS and one more market-based with the ZBIG, right?
That's right. Yeah, absolutely. So the ZBIG strategies, which we'll jump into in a second, but they're definitely more market-based, and the HIPOS is an alternative income strategy. One of the neat things I think we're going to highlight tonight, and I've pointed out the market being down, when we get to the HIPOS, HIPOS is actually up year to date. So, we have a strategy that even in this down market is actually doing pretty well.
Yeah, no, I mean, and we're kind of saving that for the end. Did you guys get to the point? I know it was because of the GIPS. I know you guys were still waiting back on approval with the returns for the HIPOS aggressive. And were you able to get that back yet, or?
So still going forth with GIPS. We meant, for anybody on the call, we mentioned this earlier, is we are a GIPS compliant firm, which means our numbers are third party audited. So sometimes it can take a little longer to get our numbers updated. So we got some numbers for you tonight, which are fully audited and official. But Brian, it can take a little extra time.
So we're
sometimes.
still waiting on June to come back in, right? For those.
Yeah. That's why we kind of get toward it. Takes us a little longer, is because we want them to be official.
Right. Absolutely. So we're going to emphasize on, we're going to look more at May, but I mean, it really tells the story anyway. So, and we can, people, just so they can get a feel for it. All right. So anyway, bullet point, ZBIG, HIPOS.
All righty.
Okay. So although here are the all 10 of their portfolio models, the bottom one, Zoom, though, is not one that I can offer through Fusion at the moment. Although you tell me at some point that may be a possibility. And that has a kind of its own kind of philosophy.
Zoom's a hedge fund, right? We offer hedge fund exposure. And that may be something available through Fusion soon. Yeah, but we still have some hedge fund type stuff with that aggressive strategy on top as well.
Right. So, but can you just kind of mow through these a little bit? Just give your whatever.
So the first, Brian answered bullet point, right? So and I love that. The high probability option strategy, we call it HIPOS. This is actually an internal strategy that our team has developed. We use the technique and we use algorithms that we built internally, and we watch a lot of different things. But this is really the alternative income space, right? So, and we have a number of different models here. We have an income model, we have a conservative, we have a moderate growth, and an aggressive. For that aggressive investor that's really looking to long-term, 4 or 5 years down the road, this is your hedge fund type exposure, right? You have the opportunity to do 15+% per year. That's our goal with this strategy. Very aggressive and alternative. But moderate, conservative
pieces of people's portfolios.
Yeah, and it could be good for a $50,000 chunk of somebody's money, right? And they want to be real aggressive with the piece. But the moderate, conservative, and income, these are great strategies that are totally alternative to what the market does. And what I mean by that is we're not predicated on what the market does. If the S&P 500 is up, if it's down, if the bond market's up or down, if the tech market's up or down, if Apple's up and down or Google, it doesn't make a difference to us. We are trying to take advantage of volatility in the market, generate income of about the conservative has a goal of 1% per month. So I'm going to dive into that strategy in a few more slides. But that's the idea. This is alternative income strategies that are designed to generate money, regardless of market conditions. If we look down, we have that hedged equity bucket, which we're going to focus on the ZBIGs, but we also have another strategy called buy and hedge, which are all available through Brian and his team. And this is that protected growth bucket, right? We have a level of growth that appreciates with the market, and then we have protection. So if the market does kind of crash or have those major downward moves for long periods of time, we can protect the portfolio significantly. So that's that next bucket. And then lastly is Zoom, which is a hedge fund strategy. We won't get too much into that tonight, but it is similar to the hypos aggressive. It's a very aggressive strategy that may be something available down the road for that real aggressive investor that wants to take 10% or so of their portfolio and really try to hit home runs.
All right, so let's jump into the ZBIG IRA. So now that they have a general understanding of what ZEGA's models are about, let's focus on that a little bit. First, and this is another bullet point, I want you to say it one more time, Mike. What does ZBIG stand for?
Sure. So ZBIG stands for ZEGA Buffered Index Growth. I'll say that one more time.
Buffered Index Growth.
Yeah, ZEGA Buffered Index Growth. That's correct. Yeah.
Write it down, bullet point.
Yeah. So this is really one of our most protective strategies and our more conservative strategies. And here's how you read this chart. So that orange line right there that you can see is the S&P 500. The blue line is our ZBIG IRA strategy. So what this tells us is that when the market moves left or down negative, you can see that we don't move down with the market. We're flat with the market, right? So these are point-to-point strategies. I want to mention that. And so it's a certain time frame that you want to stay invested in this if you want the protected outcome.
Explain that for a second. Like, what does that mean for being point to point? What happens between those points?
Yeah, so if you were to invest in this strategy today, if you want the protected outcome, you would need to stay invested in this strategy until December 2024. So just under 30 months.
What happens at that time? By that time?
Yeah, and so what can happen at that time is the market can move up and down. But if you want that protected outcome, then you need to stay in it through that period. And what I mean by that is if the market moves left or down negative in the orange line there, you can see we're flat. So the idea here is if the market moves down, you're not going to lose money between now and December.
Now it might look like it, right? When you're
right, sure. The market can always fluctuate, and your account can always fluctuate. But as long as you're in the strategy through December 2024, it's designed to really protect your portfolio.
That's the period of time you have before you exercise those options, right?
Say that one more time, Brian.
Because that's the period of time you have to exercise those options.
That's correct. Right. Yeah, that's absolutely right. That's the time frame that we selected, and we know that we can get enough income generated here in our portfolio to protect you on the downside. And so what I really like to use for this example is two buckets. So if you think about it, and let's go back to $100. If you have $100 and you put $90 in an income bucket, right? And then you put your $10 in your market bucket. Well, what we've done with the income bucket is we've designed that bucket to generate $10 in dividends between now and December 2024. So we got our 90 bucks. It's going to generate us dividends every quarter. And it's designed that no matter what happens, by the time we get to 2024, that the income bucket's filled all the way back up to 100 bucks. So we got our 100 bucks regardless of what happens.
And that's not coming from any options. That's just coming from the dividends.
That's just coming from the dividends the portfolio produces. That's correct, right? Now, what we do is we take our 10 bucks and we put that in the market. So if the market goes down, it could be worth zero. But if the market goes up, we're going to participate in that. And so what you're seeing here,
buy an option for the other 10, right?
Correct. Yep. We're buying options with the other $10. And what you're seeing here, this blue line, is the appreciation of our $10 example here. So, but because we're very protective here on the downside, we only capture about 65% of the upside of the market. So if the market between now and December 2024 goes up about 10%, well, you might get about 6.5%, right? If it goes up about 20%, you might get 13, 14%, right? Somewhere in that 65% range. So what we're doing is we're getting a certain portion of the growth of the market, but we're very tightly protecting on the downside of the market here. So
this is like almost identical to what's going on with these annuities, right?
Very similar to an index-linked annuity, right? But there's no cap on this. So here's the nice thing: is last year the market really ran. It did 28%. Well, our conservative strategy did 22%. So there's no upside cap. So if the market really runs, you're going to participate in that. And we think that that's important because the market's going to have those big years, and we want you to participate in that. So this is a great strategy if you're a conservative investor. You take a lot less stock market risk. Really, we're eliminating stock market risk here. And that income bucket that I gave an example, that's what that flat line is. Now, what could go wrong, right, is we could have widespread defaults in the fixed income market. That could rattle us a little bit. But we're very diversified in our income bucket, right? We own over 200 different companies. So if you were to have defaults, you'd have to have a lot of different companies defaulting for us to experience risk. So in a lot of ways, we feel that we're better than a lot of those annuities out there with this strategy, because we're not just one income bucket, right? You might buy a Prudential annuity that has one income bucket with Prudential. We have over 200 different income buckets for our space. So we feel that it actually protects better in some ways. But this is a great strategy if you're a conservative investor. You really want tight protection on the downside, and you're going to get 65% of the upside of the S&P 500.
And when you talk about that income bucket, you're talking about what's going on with that 90%.
Correct. Absolutely.
So
yeah, that 90%.
You got $100, or you're taking 90 of it, putting it in that income bucket, diversifying the heck out of that, right?
Correct.
And then the historic dividends of those investments build it up to be another $100. So it's adding $10 back to the portfolio. So by the time that certain period of time goes by, because you have to wait to get the dividends, right? That you're back to your minimum, your starting amount. That's why you're not seeing losses when it's on the downside here, right?
That's correct. Yeah. So, and you made a really good point there, right? You have to wait to get your dividends. And that's why we call this a point-to-point strategy. So if we're in a down market, your portfolio might be down. But what we're designed to do is we're generating dividends. And this actually pays a monthly dividend. So the reason we say it's point-to-point is the day you get invested is the first point. Right now, December 2024 is the second point. We designed it so we're going to get enough dividends to make your portfolio whole by December 2024. So even if the market's down, you should be even or flat because you're going to get enough dividends to fill that bucket back up to where you got invested.
And then that 10% that you took initially, you invested into options. And if the market's agreeable, okay, there'll be upside to that. If it isn't agreeable, there's downside. They just fall by the wayside. You just don't lose any money. You just stay the same.
Correct. Yeah, that's exactly right. So we got our $90. We know it's going to fill that bucket up to $10 by the end of our term, right? Our point to point. By our second point, we know we're going to fill that bucket back up to your original investment amount. Then we take our other $10, and that's going to be in the market, right? And whatever happens there, right? If the market goes up, your $10 is going to be worth something. If the market goes down, your $10 could be worth zero. But the idea is no matter what happens, your income bucket or your protected side is going to be full by the end. And then if hopefully the market goes up, and you're going to have some appreciation on the other side.
So that $10, is it actually in like the S&P or whatever, or is it an option to go purchase at the
It's an option on the S&P 500.
I see. So
Yep.
if
it depends how big your account is, right? If your
exercise,
account's
right?
50,000, we might only have 1 or 2 options. If your account's $1 million, we might have 20 or 30 options, right?
Right.
So we have different levels of the S&P 500 options, right? So this is based on the S&P 500. That's a good gauge for the U.S. economy. And what we're looking at here is S&P 500 options. That's what gives us our appreciation. But really what's important here, and I think one of the most important pieces of this strategy specifically, is that flat line on the strategy. We want protection first here. So if we have a down market, and if we get in a 2001 scenario where we have multiple years of a down market, well, we've designed this strategy to protect you in that environment.
Right. And so, and the reason you're not getting you're not capturing 100% of the upside is because those options cost something, right?
Correct. Yep, absolutely. That's what cost our $10. So we're going to show you a strategy here in a second that is a little bit different, and options are priced a little more expensive.
Right. So let's look at that. So this is the ZBIG standard, and obviously
Correct.
now you can see this blue line actually keeps up closer to what the S&P does on the positive side. But it looks like when you get here around the 25% downside, that's when you have the potential for your portfolio to start going down somewhat. So what's all that mean?
Yeah, absolutely. So, right, in this example, same idea, right? We're going to look at this orange line. That's what you're seeing here. This orange line is the S&P 500, and the blue line is our strategy. And just like Brian just pointed out, well, the blue line and the orange line are a lot closer on the right, right? So this strategy, we're actually capturing about 90% of the upside. So we're getting a lot more of the S&P 500, right? Market goes up 10 instead of 6.5 like the last portfolio. You might get about 9%. Market goes up 20, you might get about 18%. But what we all know, right, is investing 101 with more reward becomes what? We take a little more risk in that space, right? So in this one, what we've done is we protected the portfolio in the first 25%.
Is it in fixed income to that point?
Correct. We're getting fixed income to this point. Yep. But what we've done to capture more of the upside is we've done some options work down 25% below the market. And what we've done is we've basically sold some options that generate us a little more income, and we're able to use that to get more upside. So what does this mean? Since we're getting more upside growth, our downside is between 0 and negative 25%. Now remember, we're point to point. So if you get invested today and we go to December 2024, if the market is down between 0 and negative 25% when we get to that month, well, your portfolio should be flat, right? That's our flat line right there. We see that your portfolio is protected. But if we drop below negative 25%, you can experience losses in this portfolio. So the next 10% on the way down is actually not protected. So you can lose 10%. We max it out. You can see the line goes flat again once we go down 10%. So what we've done here is we're capturing more upside. Your first 25% is protected. Then we risk about 10% of the portfolio, and then we cap it out. So the ideal environment here is if the strategy does what it's supposed to do, which it always has, it would be that we get 90% of the upside. Your first 25% is protected. If the market goes below that, you risk about 10%, losing 10% of the portfolio. But after that, you're protected, so you're capped out at negative 10%.
Yeah.
What we feel, most investors, you can handle a 10% loss if things got really bad. Now remember, for you to experience this 10% loss, the market's got to be down 35% for you to actually lose money, right? So down 20, or well, let me rephrase it. You got to be down 25% for you to start losing money. You're capped out at negative 35. So again, very protected portfolio, and you're getting a big, nice piece of the upside.
Yeah, no, absolutely. And so even though this starts here in this graph for losses purposes, and the client, their first loss isn't seen until then. For them, it might as well be back here at the center point, right?
Correct. Yep. Yeah, exactly. As long as you're in, I remember, point to point. So we can always get fluctuations day to day, and the portfolio is always liquid. So you can always pull money out at any time. But if you want that downside protection to kick in, you need to wait till the second point, right? We need to stay invested. And you're right, Brian. If the market drops 10, 15, 20, 25%, well, your account should be flat come the end of the second point. So you should be protected. Now, what's one thing important to note here, the reason we can get this protection and we can offer these strategies is we stretch them out. They need to be at least 18 months. So 18 to 36 months is the time frame that we make these strategies to get the level of protection, to get the dividends and the income, because this portfolio also generates income. To get that protection and that income generated, you got to be 18 months plus. So we can't do this in a 6-month time frame or a 9-month time frame or even a year. We need that extra time because we need the dividends to come in to build the portfolio back up in case we have a down market.
But that doesn't mean you can't get your money if you needed it. There was an emergency, right?
That's right. You have daily liquidity in these strategies. You could put your money in today, pull it out tomorrow. There's no surrender fees. There's no costs, no extra hidden fees or anything like that. You're immediately accessible and daily liquidity.
You just won't realize the full potential of the strategy.
On the downside, right? On the downside, you might not experience the full protection of the downside if you liquidate the strategy early. Now, if you get invested today, the market goes up 30% in 1 year, and you make 90% of that in this example, you're up 27%. Sure, you can liquidate the strategy and take your 27% and invest in another strategy, or if you had an emergency, you could take it out. Not a problem at all. So the only time that point to point becomes important, which this year is a great example of that because the market's down, like we talked about, you would need to stay invested if you want that downside protection to kick in, right? So we're down, like I said, 18% on the year. If we stay down and we do not go higher and you're in this strategy, well, you should not experience losses, right? Because that's in the 25% buffered zone. Your portfolio is protected.
And it would be the same principle on the upside. If you pulled out before the market realized its full gain, well, then you'll get a gain, but it won't be the full gain that it was for people who stayed in for that period of time, right?
Yeah, you might not experience 100% of the gain. Yeah, absolutely. But the good thing is, and this is what I think we have an advantage here over a lot of strategies, is you have that liquidity option. So if you ever need the money for any reason at all, whether it's an emergency or you're buying a house or you need a car or whatever it is, you always have access to the capital, daily liquidity.
All right, so let's look at here's the final ZBIG one. It's called the leveraged ZBIG portfolio. And obviously you can see it even looks a little different here, but look at this one here. It's showing the blue line could actually outperform the S&P here in this situation.
Yeah, absolutely. So what we see here is the blue line's going from below the orange all the way to above. So same thing here. Orange line is the S&P 500, but this time we're actually capturing about 110% of the S&P 500, and sometimes even a little bit more. And so if the market really does well, you can appreciate quite a bit with that, and you're going to get 110, maybe even 115% plus of what the market does on the upside. So really, this is your growth-oriented investor looking for more growth long-term, a little bit more volatility here and a little bit more risk, right? With more upside potential, we risk a little more. So when we go to the left side of the chart, you still have that same level of protection, right? So that 0 to negative 25% is still protected in the portfolio, right? So if we land at our second point and the market's anywhere between 0 and 25, negative 25% of when you got invested, well, your account should be flat. Strategy works, right? You should be protected. But to get more of that upside, we have to risk a little bit more. So we do more options work here down below negative 25%. And what you can lose is you can actually lose up to 40% if the market really goes down here, right? So, but we do cap it out at negative 40. So if you had a major down market over the next couple of years, the market dropped 60, 70%, right? We cap it out at negative 40. And so you could lose up to 40% if the market really got ugly. We don't anticipate that happening. And I'll tell you this, for this strategy in standard, the only time we've ever experienced a downward market below negative 25% for multiple years was the Great Depression.
I was just going to answer that. I mean, that's the only time I've recalled in my research.
Yeah, absolutely. Right. It's the Great Depression is the only time that these strategies actually would have lost money was during the Great Depression, right? You had multiple down years, and those years combined were more than negative 25%. So
you couldn't have lost it all. If you were in this, you could have only lost 40%.
Correct. Yeah, we would have maxed you out at negative 40. So even in the Great Depression, marked down 60, 70%, you're maxed out at that negative 40. Over time, that strategy should come back. This is for your more aggressive investor, right? This is a strategy that I'm invested in, right? More growth oriented, long term. I still get protected though, right? It's still part of the protected growth family. I still have that downside protection, but I get more of the upside here. So great strategy for a little bit more aggressive investor.
And you're saying this, so explain how this can actually do better than the S&P. What is it? Buying more, selling more options?
Yeah.
So more income comes into the portfolio. It's not because it invested in investments that did better than the S&P. It's because it sold options that added more money back into the portfolio. And when you count it capturing the upside, the full upside of the S&P, and took in that additional money from the sale of those options, it ends up with more money or more growth than if you were just in the S&P.
Yeah, that's correct. So, right. And that's what I point out and why I say we do some options work, and we do that work all below the negative 25% line. And what we're doing is we're selling options and we're buying options and we're doing stuff to generate more income. And what happens is we have more income. So what can we do with that? We buy more market exposure, more upside exposure. So it's not that we're beating the market, essentially, it's that we're buying more of the market. And that's why you call this portfolio leveraged, right? Because you're getting 120% of the market, 110% of the market. So you're getting more market exposure. So you're getting more upside. So when the market goes up, you get to capture more of that upside. So it's a great strategy, especially if you have a long time horizon.
Absolutely. Especially if you're still capped at 25, and only time there's been 2 years of 25 or more is the Great Depression. So really, you got to take into consideration what kind of risk are you really taking to grab that. In perspective, it's relatively low as you go into history, but not impossible. It's not a fixed indexed annuity where they're guaranteed principal, but you got to be realistic about, how much risk am I taking? So, all right. So now let's jump into the final one, the high post, before we show the performance, at least up to May and since inception. And then we're going to sew this thing up. So obviously this one kind of looks a little funny. It's got like this half Easter egg looking piece here. And it also applies to all three of those high post portfolios. So do your best to break this down for us if you could. And also,
sure. So
bullet point, what does high post mean?
Yeah, so HIPOS, right? So high probability option strategy is what HIPOS stands for. And this is a proprietary strategy to us.
Remember that.
Yeah. And what we're looking at here is, this is the S&P 500. Now we do this on the S&P 500, the NASDAQ, or the Russell. And That purple cone there is where we can, with a 95% accuracy, predict where the market's going to end up over the next 30 days. Let's use our conservative strategy. So we know that with 95% accuracy, we're going to finish within that purple line next 30 days. What we do as investors is we will sell an option. Really, it's a double leg option, so there's multiple legs to it. But we will sell a position in the options market that generates us income. What the income we're trying to generate is about 1%. So we are generating about 1% every month, regardless of market conditions. And in this example, let's use that green circle down there. If we sell our options down there in that green circle, as long as the market finishes within our purple cone or above our purple cone, well, our options trade will be successful. So we're going to generate that 1%. So we have a strategy which is called hypo.
Until the very bottom is where the risk is.
Correct. That's where the risk is. The risk is the market ends down below that purple line. And now what we have, right, is we have 95% chance, plus we have the additional 2.5% chance on top.
But you know, there's a 95% chance this area, this purple cone is going from the top to the bottom. You're going to land in here 95% of the time.
That's correct. Yep, 95% of the time. And 2.5% of the time, you're going to land above the purple line. 2.5% of the time, you're going to land below the purple line. So to make numbers easy, let's call it 98%. So you have a 98% chance of success with this trade every single month. Now, I mentioned this earlier. These are market neutral strategies. So it does not matter if the market is up, if the market is down, if the market is flat. You have a 96%.
Not coming from the market.
Not coming from the market, correct. It's coming from selling options. So you have a 98% chance of success here. And we're putting this trade on every single month. So this is a great strategy if you're looking for alternative income. We do limit this in portfolios to about 20%. We don't want you to put more than 25% in here. We think it's a great alternative and it's a good complement to whatever you're doing with the rest of your portfolio. So this is not a core strategy. This is a complementary strategy that's designed to give you an alternative look at the market, to design to give you about 1% a month of returns. And it's really market neutral. So it's a great strategy to give your alternative income.
And so the different levels of risk within the hypos, which we showed, right? You got, but you have conservative, moderate, aggressive, and you have income too. I guess you could talk about that in a minute too. But is that all has to do with how often you're doing these sales and you're trading within this, and you're coming in within this bubble here between them. If it's more aggressive, you might do it more times in a month. And if it's less aggressive, the least one you're doing at least once a month.
Correct. Yeah. So our
money on those other risk level ones is more often. Right?
Yes, that's correct. So our core strategy, which is called hypos conservative, that's the one I would suggest for most clients. And what that does is this trade we discussed where we're selling options once a month to generate a goal of generating 1%. That's the idea. We try to do that every single month, regardless of market conditions. If you're in one of our more aggressive strategies, the moderate, the aggressive, we might do this more frequently. So we might sell this strategy. It could really be 2 or 3 times a month. You might see us do it. It could be 4 or 5 times.
1% each time, or
it could be 0.5%. It could be 1%. It could be. We're very active with this strategy on the aggressive side and the moderate strategy. So we're constantly trading and we're looking for opportunities. So it really depends on the frequency of trading. That more aggressive investor that's looking for a lot of activity, you could be a good fit for aggressive or moderate. Now, remember, more return, it becomes more risk. So if you're looking for more of that consistent return profile where you're just you're comfortable making that 8% per year, hypo's conservative is a great strategy. It's a good alternative strategy. And ideally, we'll end up positive this year. Even if the market's down, our hypo's conservative is very steady and hopefully, knock on wood here, no guarantees, but we end positive this year. Well, if some of your portfolio is positive this year, let's go back to our hedging slide. Is right. You're going to be protected and your portfolio is going to be a lot better shape at the end of the year than the client that just rode the market all the way down. So this is a good addition to your core portfolio that can help you grow even in a down market.
Right. And so where is the potential for loss when you come outside of this bubble? Like, I know you've talked about it. And recently, for the first time in a while, some of the strategies have seen the negative. And how did that happen?
Yeah, so absolutely. So if we get outside of our purple line here, our purple cone, that's when risks can happen. Now we have a number of different tactics that we can use to protect on the downside if that happens, or we can roll the options out, we can roll them down, we can roll up, we can do a lot of different things. But absolutely, there's, making money, right? There's always risks to making money other than a CD in the bank, right? That's not paying you very much. There's always some risk that we need to take here. And the risk here is that, we move against our 98% chance of success, right? And if that happens and we drop down in that green circle, well, we may have to do some tactics to protect against losing money in the portfolio. We might have to give a little bit back on the downside. So, none of this is guaranteed, but these are great strategies. I'll tell you this when we get to this, the next slide here, but our conservative strategy has never had a down year. So these really, they're good additions to your core portfolio. I'm sure there's some risks that come with it, right? No guaranteeing 10%, doesn't exist, right? So there's some risks there, but our performance has held the test of time since we've been investing.
It doesn't mean it couldn't have a down month, right?
Sure, absolutely. We can always have a down month, yeah, but we've never had a down year in the conservative or the income model.
So that's pretty impressive, never having. You talk about since the inception, 2011.
Yeah, that's right. 2011, 2012, I think, is when these the conservative and income were implemented. 2011 was the aggressive, but yeah, we've never had a down year in conservative or income.
That's a heck of a record, Mike. It's a heck of a record. So let's look at that. So we're going to sew things up a little. So here's our grand finale. Since we now have a much better idea what thought and strategies have gone into the ZEGA model portfolios, let's take a look at their performance and how it's and what it's been like since their inception up to May this year, 2022. I must say again, rather impressive, the fact that the high post portfolio, especially the conservative, up still this year, up at least till this point, is pretty good. Now, you did say the conservative, what did it see a negative? It did see a negative month in June, right?
Yeah. So we just have numbers here through May, right? The June numbers are starting to come out now. But you can see so let's highlight the top lines here, right? So the aggressive, the moderate, the conservative, the income, that alternative income space that we discussed, that's what that top bracket is there. And if you scroll over to the YTD, right, you got, every month there, January, February, March, April, May, all the way over to YTD, little to your left, right, there you go. This is year to date. That's what that stands for if you're looking at a fact sheet at any time. And so what have we done year to date, right? You can see even though the market's down through May, the S&P 500 was down 12%. We were actually up in all of our strategies. Now, and we all know that June this year was a rough month. So we've given a little back in our strategies, and we're waiting for numbers, but we're about flat in a couple of the strategies. We might be down a little bit. So we gave some back in June. It was a big down month. We've dropped about 10% in 3 days. Those are the risks to the hypo strategies. We call it black swan risk. You have major downward moves can hurt the strategy. So we did get hurt a little bit, but we're still, I think we're still going to look pretty good with some of the hypo strategies. Yeah, exactly. It's just 1 month. So I think we're still on track to do well. And even hypo's aggressive was up almost 17% through May. So, the 1-year performance on aggressive was up 53%. Really good performance. And really, when you look at the 5-year numbers is what I like to look at, right? The aggressive was up 16% over 5 years, moderates up 12, conservatives up 10, and income's even up 4.9, right? Almost 5%. So great performance, regardless of market conditions, right? We're not worried about the S&P 500 crashing. We're not worried about the tech bubble crashing. And Netflix is down 74% this year. We're not worried about that.
It's truly alternative. These are truly alternatives.
True alternative investments that are generating income regardless of market conditions.
The high post.
So, right, the high post strategy, right? The high probability option strategy. So great performance there. Moving to the hedged equity space. This is right. These are the ZBIGs. We'll highlight the bottom 3. We got buying hedge here as well. But these are the point-to-point strategies. So you might look and say, hey, look, year to date, these are all down. Yeah, you're absolutely right. These strategies are down. Remember, they're point to point. If you want that protection to kick in, you need to stay in the strategy through December 2024. So if you really want that downside protection, you just got to stay in it. Obviously, more conservative strategies did a little bit better through the down market this year. But again, looking at 5-year numbers on this stuff,
well, even 3 years, because you're saying the options are for 2 years, right? Within a 2-year period.
Yeah, that's a good point, Brian. Yeah, let's look at the 3 years, right? Our 3-year performance on the S&P 500 is 16.4%, right down on that orange bracket down there at the bottom, Brian. That shows us the S&P 500
right here, yeah.
Right, so you got the S&P 500 on the 3-year doing 16.4, and you got the Barclays Ag, so the bond market doing 0%. The bond market over the past 3 years has done absolutely zero. Now let's roll up to our ZBIG. Look at our aggressive strategies done 17.6%. Remember, I told you that one might get 110%. Well, there you go. We're beating the market.
And that's because
a lot of people say
stayed in for that period of time where the options were finally exercised, and then the losses were evaporated as a result of it.
Correct. Yeah, that's right. And so, but I think it's worth highlighting here is people say, hey, you can't beat the market. Well, here you go, guys. We're showing you there's a way to beat the market. It's pure math. We can build a strategy that does beat the market, right?
It's not competing on the same field as the market is. You're not just trying to go out there and bear invest. That's what they're referring to when they talk about beating the market usually, right?
Correct.
Mono, strategy ones.
Correct. And we're actually beating the market by over 1% annually here in the strategy. So again, great strategy for that more aggressive investor. ZBIG IRA, that's the most conservative one, averaging 10.6%, right? Great performance. I think most people would be pretty happy generating 10% per year. And then lastly is the ZBIG standard. So that's that kind of moderate middle of the road strategy. That's doing 12.8%. So great performance there overall. So this is a
question. Why does the one have the IRA name in it?
Oh, great question. So the IRA name actually is meant for IRA accounts. So the ZBIG strategies, the only one that's available in an IRA is ZBIG IRA. That's why we call it that. Now, ZBIG IRA is available in IRAs. It's also available in taxable accounts. So you can invest in either one. It's our most conservative one, but the standard and the leverage can only go in taxable accounts. You can't put those in IRAs.
Inside government rules, inside qualified accounts, well, the IRAs too, that doesn't allow them to use certain types of option strategies and margins and things like that, right?
Correct. Yeah, IRAs have certain restrictions that we have to follow. So that's why we built that one specifically for IRAs, a little more conservative. And all three of them can go in taxable accounts. Now, the HYPOS strategies, those can go in IRAs or taxable accounts, trust accounts, joint accounts, individual accounts. All accounts are fine for the HYPOS strategy. So you're good to go there. But this is a great 30,000 foot overview of protected growth under that hedged equity bucket there in the middle, and then the alternative income. This really is, we believe, the future of investing. We think you can have your cake and eat it too in a number of ways, right? We can get you growth in the market, but we can also provide downside protection. And then on top of it, you can add some alternative income that's going to give you money and growth, hopefully in any market. And I think the conservative and income does that. And if you have that little feeling for aggressiveness, we can always add hypos aggressive in there as well to try to hit some home runs for you. But this is really how we break down portfolios: protected growth and alternative income.
Well, there you have it, folks. So here's our resources too. I'm going to put them in the box. I'm going to leave this. Webinar up for a half hour after we end it, so you'll be able to go into the comment box and copy and paste any information we put in there. On that note, that concludes the educational part of our workshop today. But before we jump into our 6-question quiz and our Q&A for it, I know we're running a little late, but that was some unbelievable stuff, Mike. Awesome job. I want to make a very special offer to everyone that is attending. I want to offer everyone here with us a no obligation complimentary investment plan analysis. And I want to take a minute to explain a little bit about what that entails and what you can get out of it. So first, what it entails is that we actually have to meet. So we can do that one of two ways. These days, you're wondering, how are we going to meet, right? Post-COVID, right? We're going to meet. You can meet either Zoom meeting via, which is almost just like we're doing now, but instead you're both we'll both be able to see each other and hear each other, and it'll be completely private. And the other, we can meet in person at our office in Fort Washington. It's right off the turnpike. And look at the turnpike. This is the building. You can actually see the turnpike. This is a photo I have in my office behind it, but the turnpike's right over here. Second, we would meet to gather all the information one time that I need to do the analysis. And then second, we meet a second time to show you the results. So finally, what you can get out of this is a clear understanding of whether it would be worth it or not for you to integrate one of the low volatility protected investing strategies that we discussed today, or perhaps even some other recommended adjustments if they can benefit you and your current portfolio. So if you'd like to take me up on this no obligation complimentary investment plan analysis, I'll be posting in the comment box a 60-minute meeting link, okay, where you can go right into my calendar and you can book it. All you have to do is click the link when we're doing our 6-question quiz in a minute, and book it right there, and it'll go in real time. If you have any questions, also too, I'm going to be putting up that 15-minute link. If you just have questions about this before you want to book a time and do an analysis, there's other questions you have, the 15-minute link will be in there. Click it. We'll do a 15-minute call. We can actually bring Mike into a call. We talked about that, right, Mike? To go over some things, because obviously this is, pretty in-depth stuff. So if you have any questions you'd like me to answer, and we can do it that way, or me and Mike to do that. Also, like I said, we'll be leaving this open in the comment box, so you can copy those links and also those resources. So, all right, so let's jump into our 6-question quiz. I want you guys to be ready for this now. All right. Remember all those bullet points? We pointed them out pretty clear, didn't we, Mike? I mean, come on.
I think so. Yeah, we hit them hard.
We hit them hard. So number 1, what is the name of the financial instrument used to protect or hedged investments? This whole thing's about that, right? We're using what to hedge? What's it called? I'm going basic here, Mike. Really basic. So let's open the chat box, or no, the Q&A box, and let's see. Protected investing. That's the name of the concept, Bob. But what is it? What kind of instrument is it? It's a stock. I'm gonna give you a hint. It starts with an O. A stock. Come on, guys, jump in there. Option. Good,
There we go.
Bob.
All right.
Bob's quick to the trigger. He's on every month, and he's won these gift cards many times. So all right, you got that one, Bob. I think I know where you're going to want your gift card, where you always get it, right? So all right, so but put it in the right there with the questions, right where you want your gift card. So also next question. So what is the number one reason to use protected or hedged investing? All we've been doing is talking about what we're trying to avoid in the market. It's the number one reason. So that Bob got it, Walmart. What's the number one reason? The number one thing we're trying to protect our portfolio. So I'm going to give you a hint. Well, not yet. Let's see who else can jump in on it. All right, well, Bob, we're going to give Larry a jump on this because you both hit the same. It's Larry Krasley. He's my client. How's it going tonight, Larry? Yes, you're right. We're going to go with that. Bob put less volatility. We're just going for the single one, Bob. But I had to say, because Bob wins all the time, and I think he's going to get another. Give that to Larry. I hope you're okay with that, Bob. All right, Larry, good job. Sonia, right thereafter. Okay. Third question. How many major market corrections were there since between 1991 and 2021? It was a nice even number. How many? 20. You got it, Bob. See, I told you, he's quick on the trigger. He takes his number.
Yeah, everybody got it. Everybody got that one.
Everybody got it. Right,
yeah, good job, everybody.
Yeah, good job. Good one. Sonya was pretty quick too. They all hit kind of at the same. Might give out one to Sonya this time. You think that would be fair, Mike? All right. Larry and Sonya, please put in the where you'd like your $10 gift card. All right. So, fourth question. What is more important? Compounded returns or average returns on your investments? Got that, Larry? Amazon. Compounded return. That's a good. You got it, Bob. All right. So, and it's actually I should put it. It's compounded dollar returns versus average numeric returns. Okay. All right. Fifth one. This is going to be a tough one, man. I don't know if they're going to be able to pull this out, Mike. We'll see.
All right.
What does the ZEGA portfolio model named ZBIG stand for? What does ZBIG stand for? ZEGA Buffered Index Growth. Wow, oh my goodness.
Wow, I got it.
Wow. Bob got that one too. So, usually Rachel writes all everybody's names down. I got to write these down before I get too carried away.
Good job, guys. Everybody remember ZEGA Buffered Index Growth. That's great.
Yep. Awesome. All right. So final question. What does the ZEGA portfolio model named or models named High Post? What does High Post stand for? Good job, Larry. All right. High probability option strategies. Great job. All right, everybody.
On you too. Good job. Yeah, high probability strategies.
Yeah, I mean that stuff that's not that easy to remember that. That's why I pull it. If I didn't say bullet point, I think we might be hearing crickets for a while, Mike.
Yeah.
Okay, so now we're going to jump into some questions. Anybody has any questions? I have a few actually that some people had sent me in before this that I talked to, that I jotted down. But if anybody has any questions, let's jump in and let's throw some at Mike, if you have any.
Sure.
Mike, I'm going to start with this one while we're waiting for everybody to jump in on that. Well, so hold on, I want to see. All right. So first one. Oh,
Go ahead.
my other sheet, sorry. So does investing like this make the chances that you will get positive returns on your money more likely?
More likely. Yeah. So absolutely. You know, I think it's a new term over the past couple of years, but alternative income is something that people have discussed. Alternative income really is a place where you've seen a lot of money managers moving. You know, Brian, you hear this all the time, right? Around building portfolios, but you know, more diversification across different lines is really improving performance, especially for an environment like we're in today, right? So if you have if your portfolio, if you put a portion of your portfolio in our hypos conservative strategy, you really have a great chance. I'll use a double word here. You have a high probability of being more successful.
Even in years of down markets, right?
Yeah, exactly. And even in a down market. So a great example of that was 2018. The S&P 500 finished that year down about 6%. Well, our hypo strategy was up about 12. So even in a down market, you have an opportunity to be positive. So yes, adding alternative income to your portfolio or an alternative strategy gives you the opportunity, or gives you a better opportunity to make money. Absolutely. I think so there. Not so much on the protected growth, right? Those are more of a protective piece. So if the market's down, you might not lose money in that environment. You might not make money, but you're going to lose money in that environment. So the protective growth piece, no, I don't think you have an opportunity to make more money. I think you have a better chance of protection on the alternative income piece. That gives you more of an opportunity for growth because you can make money even in a down market.
Absolutely. That sounds great. Will investing in ZEGA's portfolios tie up my money more than traditional investing? We just said
So the answer to that, yeah, that's a great question. The answer is absolutely not. No, all of our portfolios, this is something that we pride ourselves in, daily liquidity. So, you know, you get in today, you have emergency tomorrow, you had to pull all of your money out or a portion of it, you'd be able to fully access all of your money. Even in our most aggressive hedge fund strategies, we might tell you it's not the best time to pull your money out of those aggressive strategies, or we might tell you, hey, it may make sense for you to wait a week, but you always have full access to your money and any of the ZEGA strategies. I think one more thing I did not mention earlier, ZEGA also operates as a fiduciary. So we are always, and we partner with Brian and Fusion on this. We always have the client's best interest at hand. We are required by law to do that. We have always, since we opened our doors 12 years ago, we've always operated that way. So always have daily liquidity, no lockups with us.
awesome. So do ZEGA portfolios get a guaranteed return every year?
So I can't use the word guarantee. No, whenever you have liquid investments like this, you can't use the word guarantee. So, you know there, if you think about some of our buffered products, and we like to use some annuities or linked index annuities as examples, they can say the word guarantee. But if you pull your investments out in between when you get invested and the end of that guaranteed strategy, it is not so guaranteed, right? You can actually pull out at a lower level. So we have the same type of strategies, but the difference with us, and the reason we can't use the word guarantee, is because we have daily liquidity. So you have the same outcome, but you have daily liquidity. I can't guarantee you're going to have the same amount of money you put in today, tomorrow. But what I can tell you is you have a very high chance of success to have the outcome the strategy is looking to provide over the term of the strategy. So no guarantees with us. No guarantees with a lot of things, we have real high probabilities of success here, and with high amounts of certainty, I can tell you what the strategies are going to project.
So, and this is saying guaranteed return, right? And it really, that's different than guaranteed principal, obviously.
Sure.
And so we're looking at those, like for instance, the ZBIG IRA, where you're across the board protecting, right? For the downside. In that instance, you're saying if you stay in for that period of time, you can basically guarantee the principal, but you can't guarantee a return.
Correct. Yeah, and I can't say the word guarantee, but yes, it's designed, and that, again, if I use that $100 example, right? You put your $100 in, it's designed to have $100 in there, regardless of what happens to the S&P 500, over the next 2.5 years. So
you just can't use the guarantee word, but high probabilities.
Extremely high probability of success. Yes.
Yeah. Okay. How much do I need to invest in ZEGA portfolios, as a minimum?
So minimums here, everything that we've discussed tonight, I believe, Brian, is a $50,000 minimum to get in any one of our strategies that we've discussed tonight. The buy and hedge strategies, we didn't get into those. They're a little higher, about 100 and 150. But we want our strategies to be available to any investor. So $50,000 across the board for all of our strategies.
But you also have a buy and hedge ETF, which I put some clients in, and that has as low, you could put in as low as $2,000.
Yeah, I mean, you can put in $20 in our ETF. Yeah, absolutely. So we do have an ETF version. It doesn't work exactly the same, and you don't get the exact same outcome. It is a tool that we use in certain scenarios. We don't use it for a lot of clients. We use it more for a kind of a tool. But if you wanted to access our strategy with less than 50,000, a protected growth strategy, you could certainly use our ETF. That is actually listed behind. Brian can give you access to that as well.
Okay. Last question. Somebody else has one here. Would you recommend for someone to move all their assets into ZEGA portfolios? So I guess I do get people when they see that, impressive, like, the hypo is conservative, and I always tell them the same that you said, it's alternative. You don't want to really put more than 20, 25%. They won't accept more than that of your assets. I look at ZEGA as diversifying among the hedged and the alternative type portfolios. It's certainly viable, but I think of ZEGA more as a diversification tool to be able to put decent portions of clients' portfolios in there, but also enhance their diversification with other types of investing. Especially, I use a lot the tactical, which I mentioned in here but didn't get into. We are doing our next webinar on that. So would you agree with that stuff?
I think, the short answer to that is, absolutely. We can take, 100% of someone's investments. If you wanted to really use ZEGA strategies, our approach is 80-20, right? Is you would pick the level of ZBIG you would like, and put 80% of your account in that ZBIG strategy in the protected growth. And then 20% would go into the hypo strategies. So if and we suggest hypo's conservative, again, that's that steady performance, 8-9% per year. We really haven't fluctuated much from there. Even during COVID, we bounced back and we did 7% in 2020. So, that's what our rule is we like the 80-20. Now, Brian and his team have a lot of different investment strategies available. He can slot ZEGA into your portfolio where it makes sense and it's necessary. He thinks is fit. So I would defer to him on how to allocate the portfolio. But if you really, really like ZEGA and you and Brian talk about, offline about it, absolutely. We'd be more than happy to manage 100%, and we would use our 80-20 rule.
All right, folks. That concludes our workshop for today. I just want to thank everyone who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about important topics like this. I truly commend you for that. And I want to thank our very special co-host for today's webinar, Mike Puck from ZEGA Financial. It's been an absolute pleasure having you educate us on hedged investing, because it's such an innovative and little understood method of investing that certainly could become a big part of so many people's financial portfolio success if they knew more about it. Thanks so much, Mike, for coming on, man. I really appreciate you doing this tonight.
Yeah, thanks for having me, Brian. I really appreciate it. It's great to speak to some of your clients and maybe some new prospective clients. I think that we really add a unique angle to portfolios and to clients. We think we take institutional investing to regular investors like you and I, and we're just excited to be a part of this. So thanks for having me on. I appreciate it. If Brian mentioned this earlier, if you want to talk on a one-on-one or with Brian and myself, I'm more than happy to jump on. Brian will set everything up with the Zoom meeting. So I talk to clients all the time. So connect with Brian. I think he does a great job explaining our strategies, but I'm more than happy to jump on and help out. So thanks again for having me. Really appreciate it.
Took the words out of my mouth, Mike. That was awesome. So, okay, folks. Well, on behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, who couldn't be here with us tonight, unfortunately, but she'll be back next time, and myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington, PA area, I want to remind you that if there's anything we've discussed tonight or anything else that matter to you, that you would, and you want to discuss it with us further, you can reach out to us at either 215-804-9708 by phone or at info@plcfs.com. Or to make it even easier, just go to our website at plcfs.com. And all our information is always there. Also, please mark Tuesday, August 30th, 2022 at 7 p.m. on your calendar for our next webinar. It's going to be called, What is Tactical Investing? And why should you know about it? Remember, we do them every Tuesday of every month. So have a great August coming up and the rest of your July, and we'll see you next month. Good night, folks.
Thanks, guys. Have a great night.
Mike, thank you.
Thank you.